of the three companies we have here, from FastJobs and from CARSOME, as well as 99.co, none of you guys were in financial services to begin with. This was something you added on afterwards. Yet all three companies are now looking at various payment systems or various financial services. We'll explore this a bit later, but perhaps you can, as we go through the introduction, you can tell us a little bit about each of your companies, and then we'll go into the questions.
Sure. I start?
Yeah, please.
Okay. Does this work? Hi, everyone. I'm Juliet, the Group President and CFO of CARSOME. We're the #1 used car platform in the region with presence in Malaysia, Indonesia, Thailand, Singapore, and Philippines in stealth mode. We started our CARSOME Capital business back in 2019, so our oldest vintage is 4 years old. We've been through a very special credit cycle over the past 2 years, and I think passing every metric with flying colors. So I'm very, very happy to share a little bit of learning and thoughts about where we are. I will still resist to be called a fintech. We're not a fintech. We don't want to be one, and we don't want to be a bank. So we are in the credit business because, not by choice, because of lack of choices.
Okay.
And happy to share a bit more about what's relevant for today's topic.
Fantastic. Julian?
Hi, good afternoon. My name is Julian. I'm the CEO and founder of FastCo. So at FastCo, we run FastJobs, which is Southeast Asia's largest job portal for the non-executive and blue-collar segment, as well as FastGig, our workforce as a service flexi-work recruitment app. So in my previous role, before I founded FastCo, I was actually running a group of online classifieds in the region. And as I traveled from country to country, Malaysia, Indonesia, Vietnam, Thailand, Philippines, I realized that a lot of the people there were not able to find jobs, and they don't have a lot of good channels. And that's when I came back to Singapore, we started FastCo to actually focus on the underserved, which is essentially the blue collar, the lower segment of society, to enable them to have equal access to job opportunities, and which is basically to help them to put money on the table. And later on, I will also elaborate on how, as we scale the business and engage our job seekers a lot more, we realize that there are a lot of financial constraints that face them, and that is where we have now, we are now evaluating how we can actually value add to them by looking at adding financial services in order to help better their lives.
Hi, my name is Darius. I'm the founder and CEO of 99.co. We're the fastest growing property platform in Southeast Asia, and in particular with the largest property portal in Indonesia. What is lesser known is that we also have a transaction services that does over 2,000 transactions, brokering, selling properties for developers in Indonesia as well. And we are taking very baby steps. We are toddler in fintech, but we started it, like Juliet said, out of no choice. We noticed that 25% of our property buyers, they are, they're credit worthy, they have good income, that they don't have enough down payment, or they don't have, their income is not recognized by the bank, they're underserved. And they should really get a roof over their head, and they really, really desire to. And that's how we got started. We're just starting to figure out how to lend to them. In fact, we don't want to think of ourselves as a fintech business likewise. We want to build credit score for them so that the banks will become off-taker 3 years down the road. Yeah, sorry. Back to you.
Well, Ganesh and Nick, please, also a little introduction for you guys as well.
Thanks very much, guys. I'm Nick, partner of Apis. And look, I think, we're a private equity manager managing about $1.5 billion focused on financial services. And, in effect, we're a derivative of what, the team are talking about here. We started from the very traditional aspect of financial services, so banks, insurance companies, what people see and feel. Moving a bit more into the kind of ethereal realm, payments, etc. And really now, I think what makes us quite excited is this kind of third leg of the evolution, which is, really kind of like many businesses effectively becoming financial services companies, right? And I think Jenny spoke about AWS, and we see kind of a similar parallel, right? Ultimately, as many more companies and or platforms are looking to be financial services companies, that expertise is not always built in-house or isn't best built in-house. And so there will need to be this kind of emergence of providers and enablers to various companies to do this. And I think like this evolution is really what kind of like is pushing fintech to be, you know, so kind of hot topic, I think, at this point in time, you know, irrespective of kind of the macro headwinds we face.
Thanks, thanks Ali, thanks all. First of all, it's great to be here. I still feel like I'm in Zooms, but I'm feeling a little exposed because you can see all of me, but I think I'll get used to this. I'm Ganesh Rengaswamy, Managing Partner at Quona Capital. Quona is Global Emerging Markets FinTech Venture Fund. We invest today in 14 countries across Asia, primarily India and Southeast Asia, Africa and Latin America and Middle East. We're running across 3 funds now, primarily have gone progressively early, and so invest anywhere from seed to Series A. And I think the theme that all 3 of them spoke about, and Nick briefly referred to, is obviously emerging very fast across the fintech ecosystem, which has been sort of core to our philosophy as well. Fintech and digital inclusion to drive everyday life cycle needs for consumers and SMEs is becoming a pretty common theme. And that's kind of reflected in what we do as well. So very exciting to see that you guys have taken the step forward as scary as
we're going to find out why in a minute. We're going to find out why in a minute. Just for disclosure for the audience, Cento Ventures, the firm that I do work with, we are investors in FastCo, Julian's business. I have asked Nick and Ganesh if I do throw too many softballs at Julian, the audience, and Ganesh and Nick are feel free to throw a few hard balls. Okay, let's get started here, guys. So you guys didn't, initially the companies here, initially you didn't start out as bringing financial services on, yet a couple of years later, they're cropping up all over your product roadmap. Can you tell us a little bit about what the drivers were behind developing these financial services?
I can start. So for cars, it's not a casual purchase. It's actually a big amount of money for consumers in our region. It's worth on average more than twice annual income. So it's hard to not to talk about financing when you talk about buying and selling cars.
So it was the size of the item to be purchased?
Yeah.
Okay.
Yeah, it's just part of the transaction. And what we observed as we started our transaction business is for the same so when you underwrite a loan that's asset backed, you talk about character judgment, you talk about asset judgment. There was a lot of the banks are doing a great job on the character side as much as they can, but there was very limited information about the used car asset as a asset class. So you start to see absurd cases where the same person buys a new car, gets 2% interest rate without any question asked. It kind of signs at the dealership, and the same person buys a used car, gets outright rejection, and it's the same person. So we came into this picture, and again, we resisted for a very long time going into lending ourselves, and we're still very restrained in doing so. As much as we can, we pass all the products and services to the financial partners. But it comes to a point that we just have to address this head on. And we actually throw our data at the banks and say, take everything we know, do something about it, and give these people what they deserve. And it just can't feed into their 20-year-old credit model.
Anybody in banking here, take note, please.
Sorry, I'm very happy to collaborate. I think we're the most open ecosystem in terms of collaboration of FIs. So, and we still remain to do so. So it really got to a point that we started experimenting, underwriting car loan ourselves. We built a pretty experienced team that used to be in the industry and open to adopt technology changes and absorb the data. We built our loan book in 2019, and as a proof of concept. very, very small. And after 4 years, our NPL is half of what we see in the industry. And I think the key
I would have to dig there. Half of what?
Half
So you do
of-
half of a little or half of a lot?
So for used car financing of our yield, which is in between prime and subprime, is around 13% for Malaysia. That's where we have our, approval concept on book. And for NPL, lifetime NPL is around 6%. I think we, even after the 4 years during the pandemic, is less than 2%. So we take pride in that number, and I think that gives us confidence
So
to
you
scale
should.
that.
You should.
Yeah.
Okay.
Yeah, so I think that became a competency that we're consciously building today. And again, because not only we have the data about the asset, about the real-time wholesale price of the used car, we can draw the depreciation curve of every model make, every point in time. But also we can give options to borrowers on when they're struggling to make payments. And this is again something pure FIs would be struggling to offer. What they do is wait till 3 months past due and start.
Maybe let's get to capabilities in a minute,
Yeah.
because I don't think the other panelists a
Sure.
chance to explain a little bit their motivation for the why they built financial services.
Yeah.
I do have a number of questions on on why the capabilities and how you built them.
Yeah.
Let's just have a chat with Julian and
Great.
Darius as well, if it's okay.
Yeah.
Right. So for us, as we engage a lot of our job seekers, we realize that a lot of them face financial constraints, and this is basically the blue collar, the non-executive segment. So traditionally, they would have had to turn to, say, payday loans or personal loans if they are unable to get the salary advancement from their employers. But when it comes to personal loans, again, they face a lot of difficulties with borrowing from financial institutions because a lot of them, they do not have the right creditworthiness for the bank's consideration. So unfortunately, a lot of this group of people would then turn to loan sharks and other types of money lenders where interest rates are really exorbitant and the conditions for repayment are very strict. And when we speak to quite a number of these people, it becomes like a downward spiral for them because they may have to take a second loan from a second loan shark just to finance the interest payments on the first loans because we're talking about 30-40% interest rates. So this is where a lot of them are, gave this feedback to us, and we are now exploring potentially with partners to see how we can incorporate certain financial services for them. And one of the areas that we're looking at is EWA, Earned Wage Access, as today we ourselves manage thousands of workers in our ecosystem already. And apart from the cash considerations, a lot of these workers also do not have the right insurance for themselves, especially the gig workers, the part-timers. So they're exposed to whether it's health or personal accident. A lot of them are not covered even on the basic level. Then on the other side, even on the employer side, and in particular staffing agencies, a lot of them are today squeezed from the margins that they can earn from employers. But at the same time, the double whammy is they have to pay the workers on a monthly basis, but they get repaid only maybe 30 to 60 days later from the employer. So squeezed by the margin as well as them having to come up with the capital.
So when you say employers, you're referring to recruitment agencies? You're referring to?
Well, I'm talking about the staffing agencies having to, when they get reimbursed from the actual employers of the workers, of the contractors. Yeah. So, given this whole market ecosystem and feedback, that is where, a lot of them have asked us to see how, given that we have a lot of data on the job seekers, on the salaries, to see how we could help assist, especially this lower segment of society to ease their financial burden.
Yeah, for us, actually very similar to CARSOME. In fact, we just copy what they do. But if you ask, the motivation is that when...
So a large asset, can't afford it, therefore...
No, but the motivation is that when somebody tries to buy a property through a platform and we meet them, they sign the papers, they put a certain booking fee, and when they try to get the bank loan, and bank loan was either not approved or they approved. Most of the time they're approved, but they are $5,000 short, $10,000 short. And just the disappointment that they have to say that, well, I was planning to get married, I'm planning to have a kid, I need this place, what do I do now, right? I think that's a large part of the motivation, but also knowing that the gap is really not that far. So we kind of first principle thinking and went deeper, right? Okay, what is your income? Can you really service this loan? And it turns out that many of them can. The reason they are short on the approval is because they have the formal income, the pay slip that they get from the company, and then they have the informal income that's not reported anywhere.
And layered on top of a 10-year-old banking model which doesn't provide the credit you need.
And the credit that the bank is based on their formal income. And when the bank said, well, hang on a minute, if they don't have this informal income reported to you for your credit score, how about if I can prove to you over the next 3 years, they're able to service this loan? Can that be an alternative behavioral score that you can use to finance them? The answer is yes. So, well, okay, I just need to kind of fill in the gap for 3 years. And that's kind of where we came from. And on top of that, there's two more, I think, the capability question we can answer.
Well, we'll get there in a minute.
So,
the answers you've given are quite, can be phrased as quite altruistic. They're quite...
No, there's NIM and...
Not just you.
Yeah,
the,
it's good
the rest
NIM,
of the panel. But
low NPL.
I'm not going to ask a couple of nasty questions if it's okay with you. Competition. Was the competition in the market what your competitors were doing? Was that a driver in developing these financial services? Who wants to take that one?
Well, I'll go first. Yes, if I can finance buyers, I sell more property for developers. Very simple.
So altruism combined with the profit motive as well. Okay, fair enough. Honest, at least.
If there were auto financing company that existed 4 years ago that can grow with us, we wouldn't have started this ourselves. So like financing companies and credit companies are not competitions for us. We do need to solve this problem together with the FIs and capital partners.
Okay, got it. Slightly take a look a bit ahead maybe on the next 5 years. How do you see financial services being part of your businesses 5 years from now? I mean, is it a core revenue driver? Is it an engagement driver? Is it, I mean, Juliet, you were quite clear. This is, you don't want to be a financial service provider. This is something you have to do.
Yeah.
What more do you expect out of it? And maybe the same question to Darius and Julian.
Yeah, so I think our current direction is we want to own the underwriting and servicing capability for engagement, of course, for profitability on that captive finance business. We don't want to own the book or the risk.
Likewise, I think we look at ourselves in terms of core capabilities, right? We will never develop the core capability of taking deposit and have a low cost of capital, right? Ultimately, the best mortgage product will still be by the bank. I don't think that's going to change. Our job is to fill in the gap, and we do think that there's going to be an island of profitability for us. We do think that's going to generate positive NIM, and we're going to develop capabilities that's much better than anybody else in the market. But that's where the gap in the market is, not the fundamental mortgage product. So that's where we will be. Yeah.
Okay, so the second nasty question, and I think probably Nick and Ganesh can probably help us out with this as well. Any of the financial services that you're bringing on board, were they fundraising motivated? Where did you find that was a story that you needed to tell to get the money out of the VCs? So maybe I'll direct that to Ganesh and Nick first. And how many, are you seeing a lot of these stories? How are you separating the companies that are really building the financial services because they have to, need to, want to, versus the ones like, that's the shiny object, that's AI, machine learning, blockchain, it's over that direction, that's where the money is. How do you separate these stories?
Sure, I'm happy to go. So all three businesses are very familiar because we have portfolio companies which exactly, we have 5 portfolio companies across these 3 verticals which have all evolved in the direction that CARSOME, 99 and Fast are taking. And it's been very organic. And I agree with what Darius said, which is your focus is, your strength is your business understanding and customer understanding, not to really be the lowest cost of capital or to be the most efficient build the most efficient credit system for your consumers. But if you have the depth of understanding of your consumers and you're able to serve the need, provide the data or information or access to be able to, for them to be underwritten effectively. And actually, I was going to ask them a question, but I don't think that's allowed.
No,
on the
ask
panel.
them, ask them.
But,
Let's make it interactive. We promise the audience entertainment.
But that's the bottom line. So to your question, I think if you ask in terms of the type of companies we see, 80% are shiny objects, right? And that's fine. I mean, it was e-commerce at one point, it was mobile commerce at another point, payments at some point, digital lending. So, human nature is you latch on to new things to be able to show that you are part of that shiny
You've
wave.
definitely been around the block a few times, 80% of...
But I guess the 20% that you're trying to evaluate is what I said, which is, are you fundamentally running a business where it helps bridge the gap? And that you can understand based on your workflow, your customer access, your depth of data with customer, and what you are contributing to the underwriting model to be able to first make them creditworthy, and to bring their cost of price of kind of getting access to the credit lower. So yeah, that's kind of how we probably look at it.
Thoughts?
Yeah, look, I'd say, I mean, like any trend, right, whether it was Web3 or AI, blockchain or Fintech, right, it is a fundraising tool, right? And it will be meant deeply in certain businesses and more shallowly in other businesses, right? And I think the point of being an investor is to separate that wheat from the chaff, right?
How are you looking, how are you separating them?
I think it's a good question. I mean, look, I think practically what you have to be in is that if your core business, and largely what we see here is mainly around ecosystem maintenance, if you're using financial services to maintain and create value in that ecosystem, then it is probably going to be additive. I think as an executive, your question should be, is that expertise I need to build in-house, or can I rather bring a third party in? In today's kind of environment of very little capital, that's an even more important question to answer. But I think to that extent, you can really understand that really the basis of financial services there is to increase the health of that environment that you operate. I think in other businesses, financial services is channel stuffing. Like things like if I have to go to BNPL, I think a lot of people use their own balance sheet to drive product, right? And that wasn't really driving the ecosystem. So
that's ended a lot of misery for a lot of people.
It would be much easier to be an investor if it was more transparent, but different use cases and different sources.
I actually want to pick up on that. As you mentioned, BNPL. In an era when interest rates are so low, money is so free that, in fact, it's been like that for a decade. There's an entire generation of entrepreneurs that have never seen a down cycle. As our previous panelist mentioned, was even some of the VCs haven't seen this down cycle. Are you, as I maybe to address the open panel here, is it's easy to hand out the money. How do you credit score? How do you handle defaults? And these are going to now be key questions as consumers become more constrained, as money becomes more expensive. Maybe I address it to Ganesh to start with, and we'll go from there.
Sure. I think it's getting progressively harder. We kind of, from our vantage point, we see a paradox. One, it's getting progressively harder. At the same time, more people are getting into it. So I think the signals of data points today are way too many. And to be able to process the right data points, and to be able to build a risk stacking of conservatism to high risk and price it accordingly, I think it's not something we see across the ecosystem. And there are some companies which are kind of building it, and it takes a certain level of vintage to build that. But unfortunately, we don't have patience in today's world. Everyone wants to be a unicorn in 6 months. It's like having a baby in a month. I mean, how is that possible? So I think we have a little bit of this paradox in the world, which is a challenge. If we credit businesses are built over a period of time with progressive learning, right? And as you build the ecosystem context into it, it takes even more time. So I think there is a way to do it, but we continue to be concerned the way it's largely getting done across the ecosystem. So there is a progressive risk stacking, and you have to really separate the noise from the signal on the data stack to see which data points go into which part of the risk stack. And that takes time and effort. And understanding of the full supply chain and ecosystem.
Maybe to Juliet, I mean, in the case of Darius, for example, you provide a loan to a house, it's not going to drive away anywhere. But in the case of CARSOME, for example, you're essentially providing a loan on a mobile asset, which can actually be taken apart and sold in bits as well. How do you do the credit scoring? How do you handle defaults?
I say, as much as anyone says they have the most fancy algorithm, it's very hard unless you're a 20-year-old company that has been doing this for the past 2 decades, 3 cycles, and can prove your kind of cycles with a lot of data. It's very, very hard. That's why we remain so kind of really conservative in building our loan book, and we do not want the risk. I think really another, topic to or perspective to add to this is, what capital are you risking? One of the biggest mistake I see is startups, platform businesses using equity to fund debt without realizing how mismatched that is in terms of cost, tenure, return expectations.
Talking about equity of the investors.
And
So balance sheet equity, right? Okay, yeah.
yeah, but just because there is money in the bank and it's easy to give out, it's tempting to use that to generate, top-line returns. But it's extremely hard, and we started the process about removing equity and accelerating credit in our journey, and starting some conversations on securitization, on like very different type of dedicated capital for that, for credit to match the profile before we scale up. But it's scary to see some of the peers who have accumulated a very sizable loan book with equity capital, thinking it's free because there's no interest payment, and now realizing they can't get out of it. I'll say that's the reason I'm kind of saying I resist being called a fintech, and I don't want to own the book or the risk, not because it's a bad business. It's just a different business. The muscles and bones you're building to run a credit business is very different from what we build as a platform and transaction business.
Got it. Okay. Just picking up on that, is you're providing these financial services as part of CARSOME, but I mean, surely it's 2 separate businesses. It's a marketplace. It's a financial services. How do you think about building the business like this? How do you integrate across the different divisions? Do you have a separate business unit? Do you hive it out completely? How do you think about this? Maybe next, follow on from Darius, please.
Yeah, so for us, it's a separate P&L, separate business. The team does have a cross-functional OKR. So instead of just driving profitability for that business, there is a cross-functional OKR that's at the top. So they do need to learn how to coordinate and actually benefit from the data we're capturing from other BUs and work to create that seamless experience for consumer. And that's number 1 priority.
Very similar. I think for us, again, I want to emphasize we're at very baby steps in our fintech journey, or lending journey at least. So separate P&L, but there must, and which we have to build specific capabilities for, in credit and enforcement and so on and so forth. But at the same time, it has to be integrated with the organization. I'll give you the specifics of why, right? Like, for example, to do property lending, we need to have a view on LTV, right? We need to have a view on property price. And property tend to appreciate, but we also need to know specifically entry price. And that's closely related to LTV and default risk. We have a data team. The data team, we have the largest set of data in Indonesia in terms of, at least on residential mass market properties. So how do we integrate that capability in terms of being able to understand what is the property value? And we need, and in the case of an NPL, one of the things that we are different from the bank is that presumably enforcement can be enacted, which is a risk part. But presumably, let's say we can repossess the house. Our bread and butter is
Singapore, I'd buy that, but Indonesia?
It's challenging.
It's a little more inventive.
Yeah, no, but that's why we build capabilities, right? We stand on shoulders of giants. We go back to the guys who have built multi-financing company and say, how do you do enforcement? You've done this for many years. We try to understand, which ex-police commissioner you need to have as your consultant. I'm not kidding.
No, I buy it. I buy it. The honesty is wonderful.
So, again, we haven't done any of it. This is just hypothesis in terms of enforcement. But for us, it's integrating the capabilities also from the core business, which is to sell property. That's our bread and butter. If we can, that's what the bank doesn't want to do, and we can do. In fact, we have the bank sales NPL as well. right? So which is why, we have to integrate the capability to say that, okay, if we have to reprocess this, can we sell it in a year or two, right? So I think that those things have to be integrated and thought holistically, and that's where we get the advantage.
Fantastic. Take note, any police commissioners in the audience, they're looking for a job. We have a position open here.
And also who you can't lend to because you can't enforce.
Maybe to Nick and then to follow up Ganesh here. How would you view a best practice model of businesses with a core offering that are now bolting on financial services? Do you have a view on how best to do this? Is it integrated? Is it separate business units? How would you think about this?
So I think what Juliet's saying is very accurate. You need to separate P&L responsibility. You cannot have lending decisions driven by sales teams because it's like a one-way road to basically financial ruin. So I think that is kind of like a prerequisite and needs to be done across the business. I think then within that, you need to understand kind of like what responsibilities are actually best internalized and are truly competitive differentiation versus what are externalized. And I think, a lot of people spend time building out, pretty complicated data sciences teams. And when you actually look at credit scoring and you look at like the degree of accuracy that you would get versus traditional kind of credit bureaus, that's maybe not the best way people would spend money on the whole. So, we think about making sure that the incentives are right. And then we think, how do people spending money being in areas that create differentiation relative to peers over time?
Yeah, I think maybe I'll just add to that and give a slightly different perspective.
Please.
Given the stages at which we invest, we probably see three kinds of businesses, three kinds of evolution. One is you might start your sort of core foundation with financial services right from the beginning. Two is you might be where, some of them are having built out the core proposition and then bolt on financial services. And sometimes we've seen the reverse. A financial services company, which is actually like some of the early wage advanced companies actually going into HR tech solutions. So the answer would probably be different for each of this. Like we had a portfolio company called India Mart, which went public, very big B2B commerce company, actually second largest in the world, and then added financial services, which is why we invested. Whereas we have a portfolio company called Ula in Indonesia, where it's kind of happening in parallel because they're recognizing a need for payments and credit from early days. So I think it's very hard at early stages to kind of build separate P&Ls. It's just kind of not possible. So it depends on what stage the business is, but what is true is your core foundation, if it's a supply chain business, if it's a B2B commerce business, if it's a real estate business, that obviously has the unit economics have to make sense. And for a while, the financial services, if it's starting in parallel, will be an enabler till you reach a point where you take it seriously enough to say, okay, this has to kind of drive itself. Because obviously one cannot be subsidizing the other or just be fueled by the other. But I think we kind of, a little bit played by the stage of the business and the evolution and how these two units might evolve over a period of time.
Got it, okay. Just in the last few minutes here, just shifting to a slightly more macro viewpoint here. Cost of capital is going up, interest rates are going through the ceiling. Inflation is, pretty much out of control at the moment anyway. The Fed just increased, 75 basis points at interest. There were hints at another 75 basis points by end of the year. What would be your advice to founders now handling building fintech businesses within their organizations in this macro environment?
I'd start by saying that Southeast Asia looks a lot more attractive from a macro perspective than a lot of other parts in the world. So, that's a good kind of tailwind, although maybe not as strong as it was in the last few years, but definitely kind of more insulated than we had seen. I think like if you were entrepreneurs and you're deployers of capital, actually, we'll start seeing an area now where better business models and people who have attractive unit economics will start to pull away. I think the digitization of some of these various ecosystems are still at an early trend. I think lots of infrastructure hasn't been built in these markets. And I actually think it was very difficult to build this in like a cost-free capital environment because you couldn't actually maintain unit economics that were sustainable on a 5, 10, 20-year basis. And now a removal of some of that support could actually allow business models that are better positioned to thrive. It obviously means there will be some casualties. But on the whole, I think when we're working with companies, we say, look, make sure obviously there's the immediate aspects around managing your runway, your cash burn, be prudent, etc. But a lot of the themes that drove us to initially invest remain there. And in actuality, a slightly easier competitive environment is net better than a retirement of a more aggressive funding environment.
I would echo what Nick said. I think there's quite a bit of nuance when you compare economy to economy and why the correction, say for example in US is so harsh right now. Part of it is because the exuberance that they enjoyed over the past 2 years through free cash handout, through almost zero interest rate, which we never saw. Like our economies essentially just came out of a 3-year recession. If intermittent lockdowns, the F&B industry is smashed. People still struggling to find jobs, and only now I think from a couple of months ago, mobility is just starting to come back because for the past 3 years everyone worked from home. So that was not a situation in US. So what we saw in our sector, the used car price in US went up by 40% because of all that exuberance. Everyone has cash, and there was zero interest. But it never happened here. Our yield is still 13%. So adding 300 bips doesn't really change consumer behavior by that much.
I just want to ask that question as well. We just went through that picking up on Juliet here, I went through a spike across the last couple of years. Massive excesses, as you mentioned, for example. So now that we're all recovering and actually seeing each other in 3 dimensions as opposed to 3x2 on a flat screen, are we going back to 2019, 2018 before COVID, or and tech is going back to that level, or how are we seeing the next couple of years moving forward? Maybe to Ganesh.
Yeah, I think we spoke about this, and the example I gave Ali is that, there was a time when we had television and we all used to literally press the buttons on volume and power and brightness, and then remote control was introduced.
You're showing your age a bit here, Ganesh.
It's true. And then remote control was introduced, and I don't know of anyone who, with a remote, goes back to the TV and starts pressing the buttons. So the point was, I think it's a once in a lifetime change. Yes, there'll obviously be drop-offs for different reasons, for frictions, etc. But we have fundamentally seen a shift in consumer and in sort of market education on digitization, on several powerful things, and I think it's a big shift.
So here to stay.
Yeah, I mean, see, it's not black or white. Nothing in life is black or white. But I think we have seen a fundamental shift, a lot of which will stick. Except for a few things we spoke about.
There's some gray area here, Darius. Some gray as well. Yes. And Nick, any comments?
Yeah, look, I think definitely in some of these more emerging markets, there will be a fundamental long-term shift. Like if we just look at deployed capital as a tool to create new business models, obviously there was a big step up globally over the course of 2020 and 2021, but the incremental amount that we saw in Southeast Asia and other emerging markets was much larger than we had seen after that. And that was into an environment where infrastructure was much poorer before. So that capital deployment into that environment is going to have long-term effects, right? And so I think, we will see kind of long-term positive changes on the back of that.
Fantastic. And just in the last 2 or 3 minutes here, guys, it's an opportunity to engage a fantastic and extremely well-experienced panelist here. Is there anybody out here who'd like to have a conversation? We have a couple of roaming mics floating about. Know everything already? Anybody? No? Okay, I'm going to pick up a couple of questions. It's a little off topic, but we do have payment experts on the panel here. I think, to Nick, this is a little off topic, but yeah, considering your experience, I think we should do the audience a bit of justice here. Is the payments market in Indonesia and Philippines overcrowded? Do we expect a consolidation? I do know it's off topic, guys. I do want to get a chance for you to engage with Nick, having that level of experience that he has in the payment space.
I'll give you a quick answer. I think the payments market is overcrowded for what is being provided. If you take the top payment providers in a place like Indonesia, roughly the 6 largest PSPs are built on the back of about 100 clients providing relatively vanilla services. I think that model doesn't have a lot of legs and is overcrowded. I think then if you look beyond that and you compare this to what some of the new age payment players like Stripe, Adyen, Mali are providing, those opportunities haven't been tapped in a place like Indonesia. So I think it is overcrowded, but because the product suite is particularly vanilla.
Can I answer the second one?
You go right ahead, Ganesh.
So there's a question which
This is what we wanted, guys, was engagement from you guys. So
So
yes.
the question is the era of pure wallets over? I actually thought they were over in 2018, so I was a little amused by this question. But on a more sort of serious note, yes, I mean, you know where I stand, but the point is, I think given the interoperability coming in or already that's coming in multiple countries across regions, and the fact that the margins or the business case does not justify purely being a TPV or a throughput business, it really has to have a greater purpose beyond just being a monetary sort of holding entity and a transaction entity. And yeah, so I think really there are interesting models being built, back to what Nick was saying, but we have all raised the bar from capital needed to build a feasible business for ourselves, especially in a place like Indonesia. So we'll see how it goes.
Fantastic. That's it for about the time we have left, guys. Thank you very much. I would like to thank our panelists, and if you could please give a round of applause for their time, as well as to Deal Street Asia for their kind invitation. Thank you, guys.